Hey, I'm Patrick Huey, certified financial planning practitioner, accredited tax preparer, and chartered advisor in philanthropy. And I'm going to use all three of those designations today because I've got three things about the new tax law, that one big, beautiful act that retirees need to know. And they need to know now because by April, it may be too late. So let's be honest. Washington doesn't rewrite the rules and create potential tax savings for retirees, or really for anyone, every single year. But this time, the new OBBA tax law brings a few real-world wins. And of course, a few landmines for anyone already retired, planning to retire, or even just thinking about it. So instead of sifting through legal jargon or listening to your brother-in-law's Facebook posts serving as tax advice, let's hit the three big takeaways for current and future retirees based on this new law. So first, the senior standard deduction just got a raise. It just got bulked up. If you're 65 or older, you're going to get an extra $6,000 off of your taxable income. Double that if you're a married couple, both over the age of 65. And yes, those boosts will now grow each year with inflation. So translation, more of your nest egg stays yours. A higher standard deduction means you'll likely be able to skip the shoebox of old receipts, and there'll be no need to itemize for most people. And if you're already budgeting fairly tightly, this is one of the rare times that the IRS just sends a little more your way. No paperwork gymnastics required. But here's a quick tip. High earners have to beware because some of this deduction phases out if you're still pulling six figures. For most, though, this is an automatic win. And we'll come back to the phase outs in just a second. They are one big, less than beautiful deal. Second today, let's settle the rumors. Social Security still isn't fully tax-free under the new law. Yes, that was a campaign promise. But they're campaign promises for a reason. Instead of eliminating taxes on benefits, as some headlines promised, the OBBA provided retirees with a larger standard deduction and left the rest largely unchanged. So why does this matter? Well, it means planning your withdrawals still makes a difference. When you take benefits and what you have in IRA and 401k balances, they still matter for planning and timing purposes. If you're close to any income threshold for either a tax bracket, a Medicare premium surcharge, or any other deduction, coordinating your benefits with your required minimum distributions, RMDs, from IRAs or 401ks, can keep more money in your pocket. Bottom line here is you have to marry your withdrawal plan to your new deductions and don't count on blanket Social Security tax relief. The rules may not be what we thought they would be, but they could still save you real money. Third, and here's the big one, nearly every benefit in this new law, deductions, credits, and exclusions, now comes with a phase-out range. Extra senior deductions, tip and overtime exemptions, child and charitable credits, they all shrink or disappear entirely as your income climbs. Translation, it's not enough to know the general rules. You need to know and plan ahead for the thresholds. Glide just over a line and your tax break evaporates. Glide just under and you pay hundreds or thousands less in tax. More moving parts mean more room for costly mistakes. So tax smart withdrawals, the timing of income, and even charitable gifts can tip you into or out of a deduction. Yesterday, you could set and forget. Today, you need to check the map every single year. Here are a few additional items to watch for. On your estate plan, the federal exemption jumps to $15 million per person. So most retirees can sleep easy. But still, get your plan in writing. State laws and Congress can always shift. Still want one last shot at solar panels, an electric car, or home energy upgrades? You better act fast. All the green credits sunset after 2025, and some of them this fall. So miss the window, you miss the deduction. Buyer beware. And charitable giving. You can now deduct up to $2,000 joint in cash donations, even if you don't itemize. That's another quiet win for generous retirees. But here's the kicker. Not until 2026. So it may pay to be a little more creative this year. Bottom line is the new tax law is a reminder not to set your plan on autopilot. When Congress changes the rules, yesterday's strategy might just be today's missed deduction. So here's what to do right now. First, revisit your estate plan. Yeah, you're likely to be under the $15 million exemption for single filers, twice that for joint, but you still need a plan on paper, not just in your head. Second, double check your standard deduction versus itemizing. If you are close, consider bunching charitable deductions or other tax deductions into a single year. For this, I recommend a 4-year projection of your income so you can review your ongoing relationship to various phase-outs. Now, I can do this for you. If you're interested, just contact me at victoryindependentplanning.com. Review your Social Security tax exposure and RMD timing with me. I'd be happy to help. Third, review your asset location and get a retirement income summary. This is not a pie chart showing what your investments are spread out across. That is asset allocation. Asset location looks at what you hold where and how it'll be taxed at withdrawal. This can be a good time to convert assets from tax deferred to Roth and tax-free for future use. But you have to pay attention to all the phase outs. Again, I can summarize all this for you. It's part of our complementary retirement tax analysis. Remember, tax rules are more than paperwork. They're a tool. But if you actually have to use them, as always, this isn't tax or legal advice. Talk to your advisor before making big moves, or talk to me. Tax projections are not as popular as they should be, especially now, where new laws make forward-looking projections and tax planning a must for all retirees everywhere. Don't let Congress's fine print steal your peace of mind or your retirement. Contact me for a complimentary retirement tax analysis today. And if you want more about the One Big Beautiful Act and what it means for retirees, just text OBBA, that's OBBA, to 239-567-5477. OBBA, OBBA, to 239-567-5477. And I'll send you a copy of our free report, Unlock Your Tax Savings, how the new tax law may open up opportunities for retirement and estate planning strategies. As always, for more, check in at www.victoryindependentplanning.com or reach out with questions directly to me at patrick@victoryindependentplanning.com. See you next time when I'll give you 3 more things to consider for your retirement, your investments, and your financial plan. Goodbye.